What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is November 11th of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, we've got a lot to unpack in relation to the updates around FTX, as well as what's going on post the CPI report that got released yesterday, tracking inflation. We've got a lot of things to talk about, from what we're expecting in the short term to the long term. So let's go ahead and kick things off. If you like the video, consider dropping a like. It's a great way to support the channel. All right, guys, so let's kick things off. First off, focusing in on Bitcoin. After a major tirade to the downside from around $21,300, we came down towards around a low of $15,563. Very close to that 14K target we've been talking about. I know a lot of you are probably wondering whether or not we have changed our targets now that we've gotten this kind of capitulation wave around FTX. Is the worst behind us here? And I want to emphasize why I don't believe we're there just yet. We're getting close, right? We're getting very close to that range where dollar cost averaging, the risk to reward ratio starts to get much more favorable and much more in line with traditional bear markets. I want to go ahead and just do what I think is really important to do before we dive into the FTX stuff, which is just zoom out, see how we are well below that 200-week moving average. This is a first in Bitcoin's history. And on top of that, if we just simply take a look at the percentage decline from top to bottom, we got to around 77.6%. Definitely looking like we might be getting close to that 80% target that I think many of us would agree is likely more in line with what we should expect. But important to step back, and again, another reminder here that an additional 3 or 4% for Bitcoin takes a lot of effort, right? That's going to take us down well below that 14K target towards around 13,600. And I would say, again, while everyone's got different opinions on this, to be a bit more cautious, I would expect if you're really trying to buy the dip and you're not going to wait for a trend reversal, which is more likely what we're going to do. We're going to wait for some kind of key sign that consolidation is going to happen. We don't just try to buy flash dips, and I'll explain that a little bit later on, right? We would likely expect somewhere in this pocket around 82 to 84% as we approach that big even level of $10,000. Again, we won't completely wait for that. We'll probably DC a little bit, but we're mainly going to be entering in on real trend confirmation to the upside. We have not seen this yet, okay? Again, I know a lot of people want to buy the flash dips here, but as you can see, price is going to take a long period of time. Even if this is the bottom, it is going to take a long period of time of consolidation before things get fixed. Trust me on this, guys. FTX, the whole situation is a complete mess. It is an embarrassment for the industry. It is going to, and trust me, I have no incentive to say this, right? I'm a crypto YouTube channel at the end of the day. It is going to set this industry back, plus all that happened with Celsius and Voyager and all the major players out there. It is going to set this industry back a year plus. You can bet on it. At a minimum, potentially a year to 2 years, with the kind of distrust this is going to build for institutions. And I know a lot of people were very excited when we started to hear the rumors about Binance potentially acquiring FTX. That is out the window. Perhaps it can come back in the future, but CZ and the entire company of Binance has confirmed that the deal is off the table, that the books, after just a day of due diligence, were so scary that they stepped away from the offer and unfortunately had to deny it. And this has pushed FTT, the native token of the FTX token, or excuse me, the FTX platform, back down to $3.2. Now, while Bitcoin has had a positive bounce up here from the CPI report, which we're going to talk about 10.5% move yesterday, right? We can see that that is not reflecting in FTT's price. So the situation with FTX is still very real. The billions and the hole that they are in for customer deposits, many of which are retail traders, especially not just globally, but also in the US with their holdings in FTX US. This is going to put a major stain on retail sentiment for a long period of time. And if retail traders aren't getting in on the market, institutions are not getting in on the market. You can bet on that. It is important for institutions to have that additional retail liquidity, that additional trade volume. And again, just looking at FTT here, this is not a good sign here. Having the official confirmation from Binance, it either says that Binance is going to wait till they get a better offer, or they're simply not touching it. And if Binance isn't going to come in with the amount of liquidity and the amount of resources they have, who else in crypto can come in and save them? what foreign entity in traditional finance, right? In traditional finance that might have the ample capital and eagerness to get into crypto, who's going to be buying these books? No one wants to buy this. Again, we'll see how it develops. If something changes, if something positive happens, which we just simply can't know if it's going to happen, then that'd be great. And I'll be completely wrong on that, and we'll go ahead and potentially start getting a bit more eager on the market if these things start getting handled well. But to be honest with you guys, risk to reward wise, this is not what you want to bet on. And we can see it playing out here. The FTT token is playing like a perfect betting market. After the news came out, it was very clear that this has dipped down. This is not a clear buy the dip opportunity. You can have a little bit of exposure, right? Toss a little money here and there, but treat it like a lottery ticket. Don't treat it like your entire investment portfolio. It is not a smart move to do that. People did this with Luna. They ended up losing even more than they had before. And again, it's important to remember that if you buy the dip here, it's very easy to start losing substantial amounts of money from your entry yet again. I want to go ahead and spend a little bit of time to dive through data science here and talk a little bit about the current state of on-chain metrics and some of the indicators we have for exchanges. Now, you all know we do this through our partner, CryptoQuant, our data science partner here on the channel. And the really cool thing is I'm going to be using my CryptoQuant dashboard here where you guys can get access to my insights. You can check out the link down below in the description. It's free. You don't have to pay anything to use it. And you guys will be able to get access towards a lot of the indicators that I personally like to use when it comes to analyzing the market. There are a few key indicators I wanted to spend some time to discuss here. The first one is talking about the net unrealized profit or loss. We've been talking about this consecutively for months, that this had not spent enough time within the blue capitulation territory that we usually find in bear markets. And boy, look at the dip that we got here from this past week, coming from a reading of 0.3, about a practically neutral indicator reading here at 0 down towards around, I think, -3, if I can get it here on the chart. There we go, 0.316. Now, this has started to push us into the capitulation territory we found in the 2018 bear market. That's a great sign. We want to get this down a bit lower here. And as we have the chart zoomed out, I want to remind everyone that it can get a heck of a lot worse. Bear in mind that these are all bear markets that Bitcoin has seen during a secular bull market. Right? And that secular bull market is that decade-long period where central banks were really propping up financial markets with unlimited amounts of quantitative easing, as well as 0% interest rates. Right? Even if the Fed, and this is the really important thing to talk about, the whole pivot crew out there, even if the Fed starts to pivot in the next couple of months, which I think would be a disaster in dealing with inflation long term. I don't think anyone would disagree with that if they understand the history of the 70s and other inflation waves. But put that aside, the important thing to understand is that even if they pivot, we're likely not going back to 0% interest rates anytime soon. We are not going back to QE like we've seen it in the past. And we need to understand that Bitcoin in its price is going to reflect to that, being more of the risk on assets here. Unless that narrative starts to change, it is quite correlated here, especially with the recent dip to equities. And on top of that, we've got the supply and profit. This is a custom smooth moving average indicator that I utilize here on CryptoQuant that you guys can get access to on my dashboard. I generally like to look for the SMA averaging around a 45-point score. This is very in line here with typical bear markets that we've seen in the past, as we usually revisit down below this value. To put it in perspective, right now, at current valuations, we are still, I think, from the lowest point only at a 51-point range. So this means that the supply and profit needs to be lower according to history. Doesn't mean it has to be, but it's one of the many indicators we can utilize to understand whether or not we've really truly hit a bottom. And it's important to note that not only do we likely need to hit these levels, but we likely need to remain in that area for a prolonged period of time. As we've seen here, we remained in capitulation. If you look at 2019, for multiple months, at least a quarter. So don't rush to buying every single dip. But I think one of the most telling charts here, and this is one of the dead giveaways, that we've got the dip buyers coming in, and that is the Korean Premium Index. Now, CryptoQuant is a really interesting company because it pulls these really interesting metrics that some platforms just simply don't have. And what I really love about the Korean Premium Index, is it's one of the exclusive indicators they have, is it measures the difference between the exchange rate for Bitcoin on Coinbase versus the broader Korean exchanges. Something along these lines that gives us an idea of the spread between the two different markets. Now, Korea is known for going in a more speculative fashion. We write about this on our dashboard here. And while usually when we see the Korean Premium Index going up, this is usually a good thing during bull markets, especially when it is sustained. When we see short-term bumps, it can be a sign that you've got speculators coming in. And speculators do not formulate bottoms. Institutional capital does. Long-term consolidation and capitulation is what does it, because you need to have the people who are providing that bid-level support that prevents price from moving any lower. Plus, institutions don't just rapidly market buy the dip. They like to accumulate over a period of time, slowly but steadily, not to impact price too much. They like to be the foundation that signals, hey, whenever that next person who comes in and market buys and pushes Bitcoin's price up 10, 20%, that's the sign when the bull market's in, right? And we don't mind paying that premium here. We'd much rather make sure we're getting in when the wave is about to move up. Now, I know a lot of people are excited here around equities and the inflation report because the NASDAQ yesterday made a monstrous move, up 7.35%, one of the biggest moves we've had in percentage gains for the NASDAQ in many months. This is definitely really exciting to see, and it's not something that can be ignored. So let's try to dive a little bit deeper and try to understand why the market had this reaction. And I gotta be honest with you all, I think yet again, like every single dip buying opportunity, quote unquote, dip buying opportunity that we have had over the past couple months where we have been met with lower highs in the grand scheme of things and then a new lower low, I think the market's got another thing coming to them, especially with what we've been seeing in crypto. Crypto is a great sentiment gauge for really what's going on in the broader financial system because it is the most risk on of any industry. And I think it's going to show us here that tech stocks likely have lower to go. Here's why. We are still right now not only below our 200-week moving average here, but if we take a look at the stronger indices like the Dow Jones, we are pressing up towards our August highs or August short-term highs, and yet again getting back up into overbought territory here. We've already been on a nice rally here for these stocks, so you need to ask yourself whether or not we've really got the room here to go back up to those previous all-time highs and continue sparking higher. What are the fundamental changes that could justify this? Well, this is what the market is starting to price in. The consumer price index rose only, quote unquote, only 0.4% in the month of October. This, to many people, is a sign, as it was lower than expectations for the CPI, that the Federal Reserve now will have an easier time pivoting. They'll have an easier time to start, lowering their rate hikes, starting to only do 50 basis points or 25 basis point hikes, and potentially keep that flatlined hike rate for the federal funds rate up there for a lower period of time and start to ease again, which could benefit equities. Now, it's rational why stocks moved up to some degree. I completely understand that. We beat expectations by about 0.2%. And that is really nice to see. It shows that the Federal Reserve is doing the right thing. It is continuously sticking on pace with increasing interest rates, cooling the economy, and getting us back to a point where inflation is going to be eradicated. I don't want to see the economy enter a recession, but to be honest, I don't want to see inflation persist for a decade and more. That hurts everyone more than anything. So we need to be able to get inflation down more than anything, and the Fed has continued to meet towards that. But there's an important couple caveats to understand. As we've gotten inflation down towards around an increase of 0.4%, we need to understand where this puts us. If we take a look at the annualized year-over-year figure, the decline we saw was roughly about what we saw back between the peak of inflation back in June to where we went in July, right? A nice decline here, almost roughly speaking about 50 basis points, about 45 basis points generally speaking. And while this is really good to see, I want to go ahead and again, while everyone is just focusing here on the headlines, take a look and keep in mind with what the Fed has told us. The Fed has said very clearly, and they've been consistent since back during that August meeting, during the Jackson Hole speech, Jerome Powell made it very clear that they will get us to 2%. 2% is the target, getting back to that target rate and slamming down that demand in order to match the equilibrium with supply and give the time for supply a chance to adjust and rebuild after 2020, which is going to take years to do. All right, so the Fed needs to keep this demand cooled for a prolonged period of time. We've only gotten down from around 9% down to 7.75%. We've got a long way to go. This annualized figure puts it in perspective. But when you start to look at it in a month-over-month perspective, I got to be honest, there's not much room to be optimistic. If we take a look at the CPI, this means that we've had the biggest expansion month over month in the CPI really since back during June, where it was at 1.32%. While it's not accelerating back to these kind of ridiculous levels, I wouldn't expect it to. The Fed is continuing to increase its monetary tightening. Still seeing increases month over month is not a good sign. It's not a good sign. It shows that the Fed is going to have to likely continue hiking for the preceding months in order to start getting this into deflationary territory or getting it down to 0 or 0.2%. Just to kind of put it in perspective, we did some calculations that essentially, in order to have an annualized 2% target for the federal fund, for the inflation rate, right? That target of 2% the Fed's talking about, we roughly need to see month over month increases of 0.166%, right? So less than half of what we've got right now on a month over month basis. This needs to come back to the kind of increases we saw in August or in July, and it needs to stay there for a couple of months. And again, it's important to bear in mind, even if the Fed hits their 2% target, doesn't mean that they're going to immediately pivot. Doesn't mean that they're immediately going back to the easy times, which is what supported equities so much. Again, I know everyone is eager to see good times again, but we got to be vigilant. We've got to be smart with our money because we've seen in the PCE and the CPI that it has remained sticky. Inflation is not showing any signs of really letting up. I'll give a great example. If we take a look at energy markets, oil is still back in a trend since back in September of setting in higher lows. And we are really, if we just go ahead and kind of turn off, if we turn off the price here, or I guess we can kind of keep our price here, but simply put, I want to go ahead and focus on what matters. This is the chart that matters, oil. And we've got the 200-week moving averages and the 200-day moving averages that are both serving as potential support and potential resistance. This is going to be the chart to watch. If we break below these weekly moving averages, by that time, you can be confident, likely, that inflation is over and that the Fed has got things under control. But if we start to get above these daily moving averages and get to 100, and oil starts to kick off another uptrend, the market's got a whole other thing coming to it, and that is going to hit equities hard, it's going to hit crypto hard, it's going to hit the whole system. What happens when oil breaks out to 150 a barrel? What happens when the White House runs out of its strategic petroleum reserve? Something we've been talking about for months in the newsletter, which has been helping to keep oil prices at bay below $100, but it's draining up pretty quick. The current administration only has about a year, unless they want to start buying more, which is just going to support oil's price. If they run out of their supplies in about a year and a half, what happens when we stop supplying that additional 3, 5, 8 million barrels a day onto the market? What's that going to do to price? Well, current demand levels is going to take it to $150, $200. And you can say, bon voyage to your hopes of inflation going down if that happens. The Fed needs to do the right thing here. They need to crush demand. They need to forcefully slow the economy down. That is their job here, and is to get inflation under control. And Jerome Powell has made it very clear. Natural gas, another thing, which had been having a really nice decline since back in August, right? As energy markets have started to cool a little bit here in Europe, we are still pressing up to the same range that if we get above it is likely going to kick us right back up to $9.46 per CFD for natural gas. Now, there's another really interesting thing that I thought I'd dive into, because when I'm going through these times, I see these kind of pop-ups in the market and equities. Obviously, when you're sitting in cash, I know everyone's like, see, I bought the dip. It was a good opportunity. Nick, are you still sitting in cash? Aren't you going to miss the opportunity? I'll be honest, I'm pretty numb here to these kind of, upper single-digit moves. I've seen a lot of these throughout the bear market and previous bear markets for that matter. And I know that generally speaking, I need to see the systematic signs, multiple signs, that there is a clear bottom. We are not here to pick dips, but rather we are here to trade trends. We do not want to bet against the Fed. We do not want to bet against the broader trend in the equity market until we start to see signs that that is starting to reverse. One of the signs that makes me confident that that isn't happening is a tweet from a very well-known and famed trader, Mark Minervini. I always mispronounce his name, but he's a really interesting guy. I've followed him for the past couple of years. I know a lot of people on my trading network who admire him and his work. And he put out a really interesting tweet. He's even someone who's been, trading these rallies, buying the dips. He's someone who's, again, more in the middle comparative to me. But he brought up a really good point, which is that today's surge in the CPI, while strong enough to carry a bit further in the near term, is a junk off the low rally led by beaten down past leaders. Big technology stocks is what he's referring to here. Led down by these leaders that are in strong general downtrends. To enjoy a sustainable new bull market, we need fresh new names leading the charge. Now, Mark has been trading for decades here, and he brings up a very good point, which is that a new bull market is not led, a new secular bull run like we've had for the last decade, is not led by the same technology stocks that have been underperforming over the past couple months during the bear market and led during the last bull market, right? It is not going to be Apple, Amazon, Netflix, Google, all these companies that have no serious growth projections performing the best in the market and being market leaders. In fact, they should continue to be market laggers. We need to be finding stocks, new sectors that are popping up much higher and are making up the majority of the market cap and percentage gains in the market. And that is not what we're seeing. We're seeing a lot of support coming in for the big tech plays off of this. We saw Amazon up 12%. We got Meta as well, coming up 10% after already bouncing substantially here at around $88 off the lows, right? This is not what we want to see in the grand scheme of things. We need to see sustained capitulation to the side. And once we got that sign that the Fed is going to finally pull back, that's your cue. Not the market's hoping the Fed is going to do something. That's happened about 12 times already in this bear market. And who knows, maybe someone gets lucky once, but that's after you face loss after loss after loss after loss. By that time, you don't have much money to use to buy the dip. I'm not talking about you, but I'm talking about the institutions who unfortunately have gotten so used. Their careers have been during a period of time where the Fed just always came to the rescue. And unfortunately is not the case now. The Fed cannot ease like it has done in the past. And we got to be prepared for that. I'm not here for you guys to rampantly speculate. I want you guys to protect your capital. That's my job here, to give you guys the best advice I can. And if you guys want to know where I'm positioned, well, we've got a few positions in crypto, as we've had for the past couple months. We're mainly in cash. And we continue to remain in cash. So that's it for today's video, everyone. Thank you all so much for watching. If you liked it, drop a like. If you got this far, you deserve a gold medal, as I tend to ramble. But have a wonderful rest of your day. Have a wonderful weekend as well. And we will continue to cover the saga around FTX and inflation and everything macro on Monday. Take care, everyone.